Good morning, everyone. Thank you for taking the time to join us this morning for Spear's FY21 pre-close presentation. During today's presentation, I'll be providing shareholders with additional insight as to how Spear has navigated the COVID-19 pandemic and its residual effects. First off, I would like to extend my sincere gratitude and appreciation to all our Spear staff and multi-room staff for their commitment and dedication traversing with us through very deep and dark valleys through this year, as well as achieving some incredible results. At the outset of the trading year, South Africa was already under severe economic pressure. The onset of the pandemic took that up a level. From April, the operating environment became unpredictable, full of unknowns, as the government-imposed lockdown set in. Whilst many measures were adopted within South Africa to flatten the curve, South Africa's economy could ill afford the level of lockdown that was to follow. The second wave of infections hampered the short-term economic recovery that we started to see towards the end of 2020. However, once again, we had to adapt to the operating environment and forge ahead. The real estate sector, amongst many other sectors, remained under deep pressure by the events of the last 11 months. FY21 has been a year that saw significant levels of tenant support needing to be provided by landlords. The months of April to September 2020 were by far the toughest on the economy and the South African people. Our management team throughout FY21 showed their incredible asset and property management abilities as new strategies and new ways of thinking had to be implemented to navigate through these tumultuous times. As a business, we reaffirm our support to the South African government, the provincial government of the Western Cape, our tenants and their respective businesses. Focus and consistency has been some of the hallmarks of our business, as Spear has maintained income statement and occupancy consistency during FY21. The presentation today is a culmination of strong real estate fundamentals, high quality assets in sought after locations, strong tenant covenants, and a team that refuses to allow our relative size nor the circumstances we face to get in the way of our mission statement aligned destiny. A word of thanks to our chairman, Mr. Abu Varacha, and our board of directors for their ongoing support and guidance. If you have any questions during the course of this presentation, please feel free to email them to info@spearprop.co.za and we will answer them directly after the presentation. Just what I'm going to be covering today in the presentation. Just having a look at the environmental update. Tough trading conditions persist within the Western Cape, South Africa and the globe. A gradual uptick of economic activity is evident across the subsectors that Spear has invested into. With economic activity returning, so has disposable income in certain regards, with increased consumer activity across Spear's convenience retail assets and other mixed-use assets. However, on the office front, a cautious approach has been adopted by numerous office users with a slower than expected return to work program. The reasons for this, we believe, is a result of the second wave that peaked towards the end of 2020 and the beginning of 2021, the disjointed academic year for government schools, in addition to an overall concern for the general health and safety of staff in the absence of an effective COVID-19 vaccine. Now that the vaccination rollout has begun, we have noticed some larger employers are driving the 1st of March onwards as a start of their focused return to work programs. The tourism, hospitality and services sector remains most negatively impacted with the lack of international tourists, various forms of prohibition and curfews, limiting their ability within these sectors to commence their road to recovery. The vaccine rollout has brought optimism to many within the related sectors, as a strong recovery will be on the horizon once efficacy levels are at heightened levels. A successful vaccine rollout will have a cascading recovery effect as tour groups, conferencing, meeting, and incentive travel will be in a position to restart. Regardless of current circumstances, the management team and the respective hospitality management teams have designed and developed attractive, localized hospitality and conferencing packages as a means to generate revenue. FY21 has been a tough year across the board. However, Spear's portfolio has withstood the pressures brought on by the pandemic. The portfolio has remained resilient, underscoring the deep value proposition that the Spear portfolio offers shareholders and investors. Spear's regional focus has allowed us to focus all of our energy and attention on the speedy finalisation of various forms of relief to impacted tenants. Tenants most impacted outside of the hospitality portfolio were those in the travel, tourism, restaurant and entertainment sectors. Vacancy creep has set in within certain parts of the office portfolio. However, it is our opinion that this is a shorter-term challenge. Active letting and asset management is well underway to place tenants in these vacated units as soon as possible. Spear has always maintained a very robust occupancy level. I'm pleased to report that for the FY21 period, we are at a 93.93% occupancy rate. So having a look at our mission statement, Spear remains an authentic dividend-paying income fund, focused on consistently operating with a strong balance sheet and delivering on our mission statement, which is to be the leading Western Cape-focused REIT and to consistently grow our distribution per share ahead of inflation within the top quartile of our peer group. Our mission statement remains our mission statement, regardless of any trading environment. We believe that this mission statement is our North Star and something that we will always aspire towards. Looking at what strategic objectives have been achieved during the FY21 year. As set out to the market in May 2020, 3 scenario plans were presented: the low road, the mid road, and the high road scenario. The low road was Spear would be collecting 60% of its rent and breaking even. The high road scenario would be Spear would be collecting in excess of 80% of its rent, accruing dividends, and would be profitable. Spear has for the FY21 year achieved the high road scenario plan throughout the year. We have successfully adapted to the COVID-19 operating environment. Capital has been preserved and liquidity has been managed efficiently. Income statement consistency has been maintained within the high road scenario. We've maintained balance sheet strength with 0 going concern risks or any covenant breach risks. We've had strong letting activity in the FY21 year. We've maintained, as mentioned earlier, a very high tenant retention rate at 93.93%. Our debtors book is under control with consistent reductions of the age analysis. We've reduced our controllable expenditure in addition to group-wide payroll and fee reductions implemented across the board. And our active asset disposal program is in progress. Looking beyond the short term towards the medium and long term, Spear will remain a regionally focused REIT that it annually endeavours to reward its shareholders with a mission statement aligned return on its investment together with distribution growth. We'll continuously narrow our asset ownership in line with our strategy of owning high quality commercial, convenience retail and industrial assets with a clear focus on fixed income as opposed to variable income investments. We will maintain our distribution payout ratio between 75 and 90%. We will continue to weave renewable energy solutions into the fabric of our business and investment approach. We will be an impact investor creating change from both an economic and socio-economic perspective. We will reduce our gearing in line with our strategy to between 38 and 43% over the next 18 to 24 months, in addition to prudently recycling our capital. We will maintain a conservative debt hedged portfolio, and we will remain compliant with the South African REIT legislation. So having a look at the impact of COVID-19 on Spear. Given Spear's focus and consistency as a landlord, the devastating effects of the pandemic have been to a degree lessened by the effort and dedication of the entire team. Our regional approach has allowed us to remain focused on solving challenges effectively and speedily. Just a summary of our operating scenario for FY21. We've collected 85% of total rental budgeted for, and that, just a reminder, that was budgeted in December 2019, assumed no pandemic, and assumed normalized income from the hospitality portfolio. Spear through the year has remained profitable, accruing dividends and operating in the high road scenario. Our balance sheet and income statement has remained consistent and meeting all covenants. Our liquidity availability has remained consistent to absorb various forms of rental credits, deferrals, in addition to covering our operating costs and interest. We have available to us 170 million rands of cash, and furthermore, hats off to our finance team, we have settled in excess of 86 million rands worth of gross debt during the period. Our funders, Standard Bank and Nedbank, remain aligned and supportive of Spear's strategies. Our solvency and liquidity measurements have been achieved successfully. Spear's FY21 renewal and relet program has been consistent, and most importantly, we have maintained our high road operating environment for the year. So moving on to the salient details of the portfolio. Spear owns 32 high-quality assets situated solely in the Western Cape, with a portfolio value of 4.49 billion. Asset value growth compared to FY20 was in the region of 7.38%, with an average property value which has increased to 139 million rand per property, which is in line with our strategy of owning properties worth over 100 million and above. We choose to own fewer properties, but properties of higher value, which allows us to intently focus on asset management and locking additional value on each of those properties. Average property valuation, 9,829 rand a square meter, which compared to our peers is very, very fairly valued and valued for well below replacement cost. Our average in-force escalation, 6.96%. Escalation rates have come under pressure, in particularly this year, where we had a 300 basis point reduction in interest rates, a drop in inflation, and tenants, unfortunately, are also under pressure, and we would rather negotiate a slightly more lenient escalation rate than incur the cost of actually losing a tenant, because that is way more expensive. From a portfolio GLA perspective, at February 2021, the portfolio was 453,020 square meters, comprising of approximately 51% industrial, 30-odd% commercial, 10% retail, and 7% hospitality. Our portfolio tenant retention rate has been excellent at 93.93%. This is particularly due to Spear's tenant-centric approach, coupled with our early engagement strategy, which we'll talk about further in the letting activity slide. Our weighted average lease expiry at 28 months. Management makes a concerted effort to push the well out as far as possible. However, under the current trading environment, tenants have a reluctance to commit for the long term, as the operating environment does remain uncertain. We as a business offer various levels of lease tenure flexibility. However, in addition to the shorter tenure leases, we are also seeing tenants committing for the longer term in the region of 7 to 10 years. Our focus remains on rent and tenant preservation in the short, medium, and long term. Thus, flexibility has to be given in certain instances. Having a look at our average portfolio rental rate per square meter, 94.54 rand. Our year-to-date collections, a very proud 96.51%, as we've maintained our focused approach to collections and problem solving during the year. Our year-to-date collections to budget, as mentioned earlier, was just on 85%. So having a look at the financial metrics. We declared an interim distribution of 29.35 cents based upon a revised payout ratio of 80% at our half year. Spear will maintain, as earlier mentioned, a 75 to 90% payout ratio in line with our cash retention strategy. We would most likely average out at around an 80% average as we balance both the cash retention component and the tax component of the business. Spear's SA REIT cost-to-income ratio for the interim period has been 40.06%. This is higher than normal. However, this is due to reporting on a gross basis per the SA REIT BPR, in addition to limited to no hospitality income for the year. short-term increases in cost to adapt to the COVID-19 operating environment, which included various forms of cash flow relief, deferments, credits, bad debt provisions, and write-offs. Spear's SA REIT administration cost-to-income ratio has been on a consistent decline after aggressive cost-cutting and payroll sacrifices were made during the year to strengthen the cash position of the business and push the business towards the high road operating scenario. Our TNAV in the region of R11.48 per share, it has declined by around 5.67% as a result of the half-year dividend reinvestment program issuance, as well as property devaluations, which were in the region of approximately R81 million. The TNAV net of distribution will be roughly R11.18 per share. Looking at the LTV, the forecasted portfolio LTV at year-end will be approximately 46%, post any fair value adjustments having been made. We do not anticipate any further significant asset devaluations coming through for FY21, other than those made in half year 21. Further details will be provided during the May final results presentation. Our fixed debt ratio is at 69.51%. This is on the upper internal range with an internal limit of approximately 75% of debt hedged at any given time, all dependent on which cycle we are in within interest rates. Our average debt expiry in the portfolio is 22 months with no refinancing risk, with in excess of R1.3 billion renewed and extended during the year of FY21. Our expiry profile will, however, extend out to approximately 25 to 26 months post current refinancing negotiations, which are being finalised as we speak. Spear's average cost of debt, 7.59%. Our average cost of variable debt, 5.72%, which makes up approximately 30.49% of our group debt portfolio, which is in the region of 600 million. Our average cost of fixed debt, 8.72%. And notably, we have approximately R250 million of that fixed debt that will be moving towards the variable portfolio within FY22, creating interest rate savings or interest cost saving tailwinds for Spear. And most importantly, FY21 distribution will be declared. Having a look at our collections, Spear's proactive, in the trenches and non-bureaucratic response has resulted in our ability to report the following year-to-date rental collection figures and percentages. The chart has been split into a half year and full year. On a full year basis, 96.5% of gross rentals billed have been collected, post deferments and credit. One can see from the slide that June 2020, January and February 2021 stand out as the toughest collection months, noting though that we have not yet closed out the full month of February, and we do still have some significant electricity charges in addition to contractual charges that are to be settled before the month end. The billings in this slide reflect revenue after all credits and deferments, but inclusive of recoveries. Our original budget, which is in the slide on the first star, reflects the pre-COVID operating revenue, including hotels and recoveries. Tenant arrears for the interim period amounted to 4.3 million, decreasing from 13.5 million reported at interims. At last measurement date, being the 24th of Feb 2021, arrears for the full year ending 28 Feb 2021 was at 17.5 million. We do anticipate a similar trend as what we saw at our interims versus the interims pre-close, that the arrears will notably reduce as we are seeing the age analysis improve on a daily basis. Having a look at our exclusions, credits and deferrals. A direct result of the COVID-19 pandemic, management had restructured, renegotiated or provided relief to approximately 198 of our 407 tenants. A slowdown was noted in tenant relief requests as a majority of our tenants were permitted back at work and as economic activity started to recommence. The second wave of infections did, in isolated cases, result in relief requests, which were considered on a triage basis. For instance, the gyms and certain restaurants, we had to partner and come alongside them to help them navigate through this return to level 3 lockdown. When having a look at the slide, we've been quite specific in our disclosures on the classifications. Hospitality, 28.9 million uncollected. We provided credits in the sum of 15.2 million. Deferrals, 6.9 million. Vacancies, 11.0 million. Stop billing at 3.2 million. And solar payments that we've received for roof rentals at 4.49 million. Having a look at the breakdown between credits and deferrals, you will note that we've segmented them for you by retail, commercial, hospitality, and industrial. In the retail sector, credits were provided in the amount of 7 million rand, commercial 6.2 million, hospitality 62,000, industrial 1.9 million. Deferrals on the retail 529,000, commercial 3.9 million, hospitality 63,000, and industrial 2.4 million. Having a look at our letting activity. So the table below reflects the letting activity for the period. Spear's asset management and property management teams' hands-on approach has resulted in a strong tenant retention activity for the FY21 year, in addition to limited negative rental reversion on a portfolio level of 1.21%. On average, we have approximately 130,000 square meters that comes up for renewal and relet on an annual basis. However, FY21, being a year like very few before it, resulted in numerous leases being renegotiated, extended, and renewed off the back of deferments and credits. Therefore, you will note that expiries and vacated GLA was at 194,000 square meters, together with the fourth column, with renewals and new lets at 177,000 square meters. Having a look at our balance sheet and funding updates, covenants. A proactive approach was adopted with our funders to ensure that Spear has enhanced optionality, headroom, and flexibility to operate through the pandemic period without any potential covenant risks or, importantly, distractions. Management had reached agreement with our funders to relax Spear's strictest bank covenants for FY21 and FY22 measurement period as follows. Our historical LTV, 50%, our new LTV, 55%, versus our current LTV of 46%. Our old ICR, 2 times, our new ICR, 1.75 times, with the current ICR of 2.08. Notably, we believe that our ICR will be on an upward trend, given the fact that as conferencing, meeting activity starts to improve within the hospitality portfolio, the efficacy of the vaccine rollout, with people being able to travel, income would start to be generated from those hospitality assets in the short to medium term. The above relaxation reinforces the alignment of our funders to our operating strategy, and again gives comfort to all that there is zero going concern risk, in addition to Spear's ability to pass all solvency and liquidity tests. We will expand on our LTV sensitivity and roadmap further in our final results presentation in around late May this year. But again, to just reiterate, our targeted LTV is targeted at 38 to 43%, which we believe will be achieved within the next 18 to 24 months. Just going a bit deeper into our sectoral performance on a year-to-date basis. Sector-wide, the impact of COVID-19 has been felt in varying degrees. The resilience of the Spear portfolio has been displayed in the level of collection set out earlier in the presentation, along with the below sectoral performance update. We start with the retail portfolio, 42,229 square meters, of which approximately 38% of that portfolio is occupied by national tenants. All our retail assets are classified as convenience retail. This subsector has been incredibly resilient and has shown a very strong recovery. Our retail portfolio occupancy is at 91.59%. Our collections have been at 93.43% versus revenue billed for the period. Spear has provided credits and deferments to retail tenants to the value of 7 million rand of credits and R500,000 of deferments. During all levels of lockdown, our retail tenants have performed in line with expectations, with all anchor tenants being able to operate under level 5 lockdown. Letting activity has been in line with expectations, with the bulk of renewals being concluded per management's forecast. No significant retail tenant failures occurred during the year. However, Spear has elected to not raise rental on certain of the gyms. However, I'm pleased to report that those rentals have recommenced, but there was certain support having to be provided when we went back into level 3 lockdown. We're also pleased to report very encouraging tenant feedback being received on trading conditions as some level of disposable income returns. We do also believe, given the fact that Spear's convenience retail assets are all open-air shopping centres, that they should, by virtue of it not being mechanically ventilated, trade better over the next 12 months as the residual effects of the pandemic work through the system. What are our views on risk? We believe that the convenience retail portfolio is at a lower level of income risk, as close to 100% of tenants are trading and paying 100% of their rent. The gyms, as I mentioned, are taking longer to recover to pre-COVID levels, requiring longer-term restructures in the second wave. And then pressure, as we know, on the consumer spending as South Africa trades through a recession, which will potentially impact the convenience retail sector and tenants' abilities to pay their rent. So moving on to our commercial portfolio. 140,023 square meters of incredible assets. All of Spear's commercial assets are located in very attractive locations. And just to talk for a second on working from home. Again, I would reiterate that it's not a one-size-fits-all solution. Therefore, office space in good areas will remain relevant, but landlords will have to think about the overall experience of coming into the office, how the office environment will be or ecosystem will be managed, and how to make it more attractive from a health and safety perspective, as well as from a flexibility perspective. You may find that tenants will choose to operate from an office for 3 or 4 days a week and then test a hybrid work remote structure the other days. We are again, as I mentioned earlier, encouraged by news of numerous companies implementing a return to work program from the beginning of March 2020. The office portfolio occupancy is at 87.48%. As I mentioned earlier, vacancy creep has set in as a result of tenants electing not to renew their leases, some liquidations and some business closures. Collections in terms of revenue billed have been at 97.49% for the period. Spear had provided credits and deferments to the value of 6.2 million in credits and 4 million rand in terms of deferments. Spear's portfolio remains attractively positioned to offer tenants both expansion and or contraction space. In certain parts of the portfolio, tenants have needed to increase their premises size to comply with COVID-19 social distancing requirements. The impact of load shedding has also caused tenants to rethink their decision to work from home. All of Spear's office locations are equipped with business continuity solutions in the form of backup power generators. In other parts of the portfolio, headwinds have emerged within the office sector, with tenants not electing to renew their leases, as I mentioned earlier, as they test the hybrid work from home strategy. What are the risks? Asking rentals will soften as vacancy creep increases. Increased vacancies would result in increased competition for tenants that are in the market to relocate. Generally, the potential is high for negative rental reversions across the office sector, irrespective if some of the rentals are already at market or slightly below market. And the cost of installing tenants will increase as a result of the increased competition. Moving on to our industrial portfolio, 226,992 square meters of GLA. Spear's industrial portfolio has been resilient over the year, with a number of new lets and relets taking place in very challenging market environment. The industrial portfolio occupancy is at 97%. This is post the finalisation of the redevelopment at Beacon Way for Grindrod Logistics. Collections are at 96.71% versus revenue billed for the period. Spear has provided credits and deferments to industrial tenants to the amount of 1.9 million in credits and 2.5 million rand in deferments. The second half of the year saw credits and deferments reduced due to tenants' ability to reopen and operate under level 4 onwards. The vast majority of Spear's industrial tenants have maintained very strong payment profiles. And given the location and the quality of Spear's industrial portfolio, there has been strong demand for our rental properties. Again, just talking about the risks. Load shedding may have a negative impact on manufacturing tenants. Labour relations and trade unions unrest, increased capital requirements to maintain the quality of industrial assets, and major market or tenant failure. So moving on to our hospitality portfolio, 27,606 square meters. The most challenging part of our business, but a part of our business nonetheless, which we will give as much energy and effort to as any other part of our business. This sector has by far been hit the hardest by the impact of COVID-19. Management had eliminated hospitality income from our FY21 forecasts. The FY20 hospitality portfolio comprised approximately 7% of group revenue. Having a look at property specific, the Doubletree by Hilton in Cape Town. The industry showed slow recovery from September to mid-December when the second wave was officially confirmed and stricter lockdown measures were imposed. 6.2 million rand in turnover was generated in the 6 months at 13.2% occupancy and 820 rand average daily rate. We furthermore generated 2.5 million rand during the level 4 lockdown, offering repatriation services. And given the fact that this property is owned and managed by Spear, this revenue that was generated was effectively utilised to cover costs. Therefore, when you look at our credits and deferment slide, you will note in the notes that 1.7 million rand of rental income was generated from the hospitality portfolio, and that was generated from 15 on Orange. Aggressive cost cutting was implemented and non-essential services have been done away with. The cost cutting measures have been cemented into our post-COVID recovery plan. The recovery forecast based upon the initiation of the vaccine rollout and decline in active COVID-19 cases look as follows. March, 17% occupancy. However, that excludes conferencing, meeting and food and beverage, which we have seen an increased demand with some smaller bookings for conferences and meetings coming through in March, which again underscores our opinion why we believe the office sector return to work program is underway, as companies are making bookings with us at the various hotels to offer training and reconstituting business operations meetings before they return to work. April, we're looking at about 19%, May 22%, and June 31%. We're forecasting to sell approximately 5,000 room nights from March to June at an ADR of between 790 Rand and 850 Rand. A potential hospitality tailwind towards the year end would be the Lions Tour, but that still remains to be seen if it's going to be going ahead in South Africa. Having a look at 15 on Orange. 15 on Orange is under lease to Marriott. It reopened on the 8th of September 2020. We generated 1.7 million in rental income on a year-to-date basis. Spear has zero exposure to 15 on Orange Hotel's property-related expenditure. Spear accrues rental on all hotel revenue generated on the property. And Marriott remains responsible for all sales and marketing of the hotel, with numerous accommodation and conference inquiries being received for the periods from March onwards. What are the risks? Business travel market recovers slower than expected. SA borders remain closed for international travel. And when I say closed for international travel, it's more about people having to travel, even though the vaccination rollout has occurred or is occurring. People may have to isolate for a period of time and may not be able to travel for an extended period of time if they have to go back into some sort of isolation prior to returning back to their work. The meeting incentive conferencing market may become reluctant to meet in larger groups. Geopolitical risks may increase, in addition to safety and security concerns, in addition to the prolonged finalization of the COVID-19 vaccination and global rollout. So in terms of the general business update regarding most or all sectors, the general trading conditions remain very tough, but we have seen increased demand for Spear's rental properties. The industrial and retail sectors are showing the most resilience. The office sector vacancy creep has set in with a slowdown in rental demand in some areas. There are positive signs emerging in the hospitality portfolio as rooms, conference space and meeting space bookings pick up. As noted on SENS, the 15 and Orange disposal negotiations were terminated with a prospective purchaser. However, work streams are in place to follow through on our planned hospitality exit. Collections remain firmly in line with management's high road scenario. Our balance sheet remains robust. Our debtors book is on target with a good recovery momentum of receivables. Our asset disposal and LTV reduction program is ongoing and in line with our stated strategy. And our renewal program is in line with management's forecast. So having a look at our outlook, Spear's portfolio remains of a high quality, well located, sectorially defensive and underpinned by strong lease covenants. Our hands-on asset management and focus has resulted in the high road scenario being achieved for FY21 and for the foreseeable future. There's been a slow but notable economic activity which has resulted in increased inquiries for our rental properties. The vaccine rollout with a high efficacy rate will create tailwinds for the economic recovery. We plan to maintain the high road scenario through FY21 and beyond. Our disposals program will be maintained through FY22 until the strategic LTV objectives have been achieved. Spear remains well capitalized with sufficient liquidity and headroom facilities. Our leasing and asset management team report increased market activity. Our active engagement and early stage success with FY22 renewals is very welcomed. Our regional focus and proximity to our assets remains an advantage. As mentioned, the LTV range for year-end will be in the region of 45 to 46.5% and declining as disposals are finalized and the LTV reduction strategy gains momentum. There will be no major valuation declines expected for the year ending Feb 2021. And just in closing, South Africans are known for their grit and resilience. This is needed now more than ever. That brings us to the end of this pre-close presentation. Christian Barnard, our CFO, and I will follow on shortly with the question and answer session. And I thank you for your attendance today. Welcome back to the Spear pre-close presentation Q&A session for FY21. With me is my esteemed colleague, our CFO, Christian Barnard, and we are going to just be answering some of the questions that have come through post or during the presentation. I'm going to just ask Kim to just start with the questions.
Thanks, Quintin. The first question is from Milka Investments. You stated that Spear's intention is to exit hospitality. Can you comment on the level of interest from buyers in the market in terms of your hospitality assets?
Thank you. Correct. So we did state that Spear intends to exit its hospitality investments in an orderly manner, and we have been encouraged by the level of specialist hospitality investors that have engaged with us. We did note that the termination of negotiations on the 15 and Orange disposal, but I'm pleased to report that we have various work streams, as I mentioned in the presentation, underway to restore earnings and to impact our LTV reduction strategy through the disposal of our hospitality assets. We've also received notable interest from investors looking to invest into the mixed-use asset within which the Hilton property is located at the Upper East Side.
Thank you. The following question is for Christian from Primrose Investments. In your renewal negotiations of 1.3 billion of debt, have your funders been aggressive or stable with regards to their margins?
Thank you, Kim, and good morning, everyone. In all the negotiations, we've mostly found them to be very stable, and we've mostly actually received reduction in our margins, which obviously will mean a positive tailwinds for Spear in the upcoming financial year, meaning we will save on interest, meaning more profitability to shareholders.
Thank you. Another financial question for you, Christian. Given the fact that solvency and liquidity has become a talking point in the industry, do you believe that Spear will meet these requirements?
That is a great question. Solvency and liquidity is something we monitor on a daily basis, as well as the cash availability. Myself and Quintin sits with our executive committee on a weekly basis, and we review these requirements. And we believe, since we are collecting debt within our high road scenario, we are able to meet all obligations that become due, and we will be able to declare a dividend come our final results presentation.
Thank you. Quintin, is it your considered view that there will be a return to office demand from Green Star Holdings?
Yes. I don't think I'm an outlier in my thinking, but when we look at larger office users, there has been somewhat of a knee-jerk reaction, and yes, there was a human and healthcare response required to respond to the impact of the pandemic. But again, nobody wants to spend their career in a spare room. Nobody wants to go through their career virtually, and we believe that skills development, knowledge sharing, and the ability to either close deals, pitch deals, and operate in an environment that requires engagement has to happen in an office environment. How that would look like in the future may not exactly be what we've been used to, but I do believe that the demand for office space will still be there, noting that there's a telecommunications company that has just signed a 6,000 square meter lease with another landlord in the Cape Town CBD periphery. And that, for me, is already a very encouraging sign that people will be coming back to their offices.
Thank you. I've had another question regarding offices from ABAX. Which of the office properties or the larger office properties are you concerned about?
So it's maybe just to be clear, the concern or the impact in terms of vacancy creep has been mostly felt in your small to medium enterprises. The bulk of Spear's larger tenants are on long-term leases and are with very strong covenants and also very strong balance sheets, noting that small to medium businesses that underwent a deep lockdown of quite a few months that weren't able to generate revenue, very few of them were faced with no other choice but to either close up their businesses or move out. However, I must just state that as economic activity has started to return and a little bit of confidence is returning to the market, we are starting to see that inquiries for those spaces that have been vacated are starting to increase as new business ideas, new plans, new strategies are being formed by individuals to create and to sustain a living.
Thank you. A question from Clearance Capital. Good morning. Could you talk to the disposals achieved over the period? Have 12 Pickwick, 142 Edward, and Island Business Park all transferred during the period? Have any further assets been sold?
So unfortunately, none of the assets have transferred as yet. We are still in a due diligence process on Island Business Park. Unfortunately, our purchaser for 142 Edward tragically passed away, and we obviously think of his family during this time, and the 12 Pickwick is still under negotiation. We do anticipate that over the next few months that we would have some transfers coming through into the portfolio. But just given the onset of the second wave and just reverting back to a level 3 alert level did create a bit of discomfort in the market. However, on the rest of the portfolio, we haven't exactly identified specific assets that we are actively marketing, but we have noted that the private investor market, given the drop in interest rates as well as the drop in money market returns, have approached us on numerous properties, which, as I've mentioned before, there is no holy cow in this business. If a property or an offer is presented to us, whether it's solicited or unsolicited, we're presented to our investment committee. We'll look to unlock shareholder value at every opportunity, and then if it comes through, it comes through, and we will prudently recycle that capital.
Thank you. And the final question I have from Abma Properties. Once you've executed on your LTV reduction strategy, what are your top priority growth assets?
Thanks, Kim. I believe that our business will be very well positioned to take advantage of growth opportunities post our LTV reduction strategy being implemented, where we will look for further investments into high quality industrial assets similar to what we own already, in addition to convenience retail. We are also exploring opportunities within the data center real estate space, in addition to the cell tower space. However, that's very early days, but we do believe that given the world's insatiable demand for data, that in addition to some of our properties already having very high level of electricity supply coming into them, that there may be some synergies going forward in the data center space from a real estate perspective.
Thank you.
There's just two late questions that came from Coronation. I will ask to Quintin. Question 1, did incentives increase with lease renewals?
Let me think about that. Out of the ordinary incentives, not generally, but the cost of installing the tenant. So generally speaking, we would offer in the region of 1 month per year of lease as a landlord's contribution. However, as businesses have morphed into operations that are looking to retain cash, we have had to come alongside them and front end maybe some of their furniture purchases and amortize that over a period of the lease, not into our income, but into a recovery process. So that has increased, but also we would choose to, from a depreciation perspective, rather negotiate a prolonged beneficial occupation period than a too expensive installation costs, given the fact that pre-COVID tenant balance sheets may not be the same as what they are post-COVID, and going forward, if they are more entrepreneurial businesses, the risk may be higher that they may not necessarily become a sustainable business. So we've got to look at it from an accounting perspective, where we would rather offer maybe a longer BO period versus too high or too big a check for them to move into our premises.
The next question is a tricky one, which we have to answer with some cautiousness. Does your net trading assets of R11.18 after dividend imply a 30 cents second half dividend?
Well, I guess we can only disclose what's been disclosed on SENS. So at this point in time, we have not disclosed on SENS what our final distribution will be. But we are confident that we will be making a distribution. More than that, unfortunately, you'll have to tune back in May and receive the news that you receive.
There's nothing more from my side.
Thank you very much, everyone, for logging on. We appreciate you taking the time. We furthermore appreciate your ongoing support as our shareholders, investors, and interested parties with looking into Spear. We assure you that we are doing our best. We are out there in the trenches, doing what we do best, looking after our properties, engaging with our tenants, being close to our assets, and looking to grow our business in many more ways. So thank you very much, and be safe. God bless.
Thank you.
I didn't actually want to read it, but I read it just because he should know he can't answer.